Interest rates have been a hot topic since they went up in 2023, and our predictions were that rates were going to remain steady all throughout 2025. But Trump's tariffs are putting a little bit of a swing on things, so we're not exactly sure what's going to happen now, but we are breaking it down in this video.
Yeah. By the way, we love your guys' feedback on this. I have mine. So one of the things that people are talking about right now is stagflation. Obviously, they're throwing around inflation. They're throwing around recession and all those kinds of things. And there's all kinds of really, really smart people weighing in on this topic. But one thing is for sure, that the tariffs, this tariff war, this global war, I saw somebody call it a cage fight the other day, which I thought was kind of funny. In fact, just 2 hours ago, Trump saw like 50% on China. I don't know if you saw that. That just came out this morning. So it's going to be very, very interesting because he's not one to back down. But it's going to create inflation.
Well, let's just first, before we get into that, let's break this down. So everyone is looking at the interest rates and they're going to say, are they going to go up or are they going to go down? And honestly, there is a case to be made for either one. So I know a lot of people that are in the market right now are really waiting on rates to go down. I know they went down slightly this weekend because of the 10-year, which we'll get into. But honestly, they could go up based on this stuff too. So let's kind of get into it. So Jerry, if you can pull up what Jerome Powell has said about the tariffs. Tariffs will cause higher inflation and slower growth.
Right, which is stagflation, essentially.
Yes.
Also, you got to throw in unemployment, which is another. Now, by the way, for those of you, some of you might have been around in the 70s. I was a little kid. I do actually remember the long gas lines and all that stuff. Danielle, do you remember that? Just kidding.
No, definitely
so
don't.
Listen, that was around oil, the oil supply shortage. That was energy costs went up, unemployment went up, inflation went up, and that is technically, I think, the last time we saw stagflation. That's what people are talking about. What I think is really interesting is if you go back to that time frame, which is we don't know if this is going to happen. Guess what the Fed did during stagflation in the 70s?
What?
They increased rates.
Yeah.
Because if you think about it, the Fed's done this over the years. When inflation went up to 9.1%, it was it June, I think it was, of 22? Yeah, June of 22, it hit 9.1%. We all know what happened after that. They started raising at like 3/4 of a point. I think they did it like 3 times. Then it was in the 50% base, and then it's a bunch of 25. So,
but what's interesting though is Powell's saying it's going to increase inflation and slow down the economy. So typically inflation happened back in 2020 because the economy was booming so much, everybody was buying everything.
Well, that was from all the stimmy checks.
Right. So it'll be interesting with this because yes, you're going to have inflation, but if you also have a slowing economy, that means job loss, that means all those things, and Powell's really going to have to weigh all that in.
That's why I went back into the 70s because this is what happened. Like unemployment went up, energy costs went up, and inflation went up. All that happened in the 70s. They called it stagflation. And the Fed responded with higher interest rates. Now, that does not bode well for us real estate investors, obviously.
Right. Yeah,
so,
that's not what we want.
Right. But there is a lag to all this, too, right? It'll be interesting to see. As you guys know, even when a rate, if you go and just Google this, when the Fed increases a rate, even when they did this back in June of 2022, there's a lag. They say the lag could be 9 months to a year before it actually starts to work itself out. So these are, although this is the talk of the town, all my friends are talking about this. In fact, in the commercial, I read something on the commercial real estate this last weekend. I was like, everybody's wondering how it's going to affect real estate. Well, it's going to affect, and if you're in the multifamily business or single family, let's say, it's going to be drywall, primarily. We get that out of Mexico. Lumber, let's say, out of Canada.
Well, right now he's not putting tariffs on Mexico and Canada.
Correct.
Right.
But the one thing that it did mention was industrial. So industrial's been on fire. So when I look at the commercial real estate sector, I'm looking at self-storage, I'm looking at industrial, I'm looking at commercial office, I'm looking at multifamily, I'm looking at retail, I'm looking at all those different kinds. And they're also very, very different. Well, industrial has been the darling child specifically because of last mile distribution. So last mile distribution is kind of a new concept, which is like when you order something on Amazon at noon, or maybe your wife or your husband, well, you want it there like in an hour. That's basically the way we are now. So that stuff has to be just somewhere near you. Whereas before, I don't know if you guys remember this. Remember when you'd order something, you'd have to wait a day or two? Not anymore. So that's last mile distribution. What that's done is it's created issues positively for industrial space all around every major city. And so that specifically is what they're calling out as regard to these tariffs, because that last mile distribution could potentially be suffered because those are warehouses full of stuff.
But basically what you're saying is all that stuff is not from the U.S.
Correct.
And that's why they would suffer.
Right. It's coming in from the ports. So where it could really hit is from the ports, the West, the East Coast, both. And of course in the industrial space, because and so that's essentially the kind of the first line. They were saying that the hotel business of all things and industrial were the ones being called out. They're probably going to be the first ones hit from these tariffs.
So Douglas on YouTube thinks that stagflation is only short term because of demand destruction. Interest rates will fall. He said, remember Bernanke started cutting rates in 2008 when the CPI was running at 5.1.
The helicopter. They call them the helicopter. They dropped the money from. Yeah, I do. Yep, he's right. And it could be short term. It'll be very, very interesting.
Well, let's kind of look at a couple things. Let's look at why tariffs make inflation kind of go up.
Sure.
Right? So tariffs are basically an import tax. So, Trump wants to state that, the other countries are going to be paying the taxes. Other people argue that the American citizens will be paying the taxes. But either way, it's a tax on goods coming to us from other countries. And then if we start making them in the U.S., they're going to have to be more expensive because it's going to cost more to manufacture them here. I think that
this is a labor cost problem.
It is, but they were even saying the iPhone could be thousands of dollars more produced here.
I know.
And Americans then have to pay that price.
Oh, I get it. No, I get it. He's trying to bring jobs back into the U.S. That's kind of the whole point, right?
Yeah.
And the reality is to be competitive, we've outsourced stuff. Right. It's been a while since I looked, but the iPhone and the iPad, were all made in China, and all manufactured there, and that is the whole reason why you can still buy one for, I guess, reasonable price.
But you have to look at that just on homes as well, right? Like when you build a home, you import a lot of the material. So homes are tricky when it comes to all this stuff. I was just talking to my girlfriend Shannon this morning about this because she's like, well, is real estate going to, go down because of all this? Well, it's interesting because right now builders build new homes and that brings on more supply. But if it's more expensive to build a home, they either aren't going to build or they're going to have to charge more for a new build.
They're already doing that, by the way.
Correct. Right. But if new build costs go up and you have a home that is not new, it inherently is going to go up to reflect the prices of the new homes as well.
So I have friends that are in the home building business. And so let's just go back to the supply chain shocks. So it's not a perfect example, but it is an example. What happened is if, let's say you walked into any home builder anywhere in any subdivision anywhere, and you walked in and you said, I want to buy this home for $500,000. Well, and you locked it up. And then what happened was the supply chain shocked from the pandemic. All of a sudden, it took all the profit away from that builder because they're out there selling, they're signing up contracts. And so anybody who got locked in, a lot of those home builders, they ended up actually taking a loss because a homeowner had a contract. And I know there were a bunch of defaults and a bunch of stuff that went on around this. Certainly, it was all over. Then what happened was they could take a reservation, and they said, we can't give you a price because we don't know exactly the cost of all our components and how we're going to put all that together. So that's actually what could potentially happen now, is there's a lot of uncertainty on pricing for new homes for sure, and for apartments for sure. We just don't know how it's going to affect us.
Right, but it definitely will have an effect on
For
those
sure,
building
right.
on those building costs.
And to your point, it's going to have to get passed back onto the consumer, because a home builder is not going to build a home and lose money.
Well, and I think people need to understand that. So, there's people on YouTube saying, how do you know that tariffs are going to cause inflation, right? Well, somebody's got to pay it, right? Now, you could say, okay, China has to pay the whole tariff. Well, okay, but they also need to make a profit. So, I'm not saying that if we charge 50% tariffs on China, everything's going to go up 50%, but they have to make money. So it's going to go up because their cost to do business just went up. If we bring manufacturing back to the US, our labor is substantially more expensive than overseas. So prices have to go up because, people don't do things for free. People don't build houses for free. They don't make cars for free. They don't make, skincare for free. So they need to make money. So the money has to be made somewhere. And if their cost to do business goes up, they're passing maybe not all of that, but some of that onto the consumer.
Well, I think you just got to break it down really simply. If you can buy an iPhone in China or let's say Apple has them done for $500, let's say, and they sell them in the US for $1,000. The whole goal is to have the iPhone, let's say, be made in the US. You're not going to make that iPhone for $500, period. So that's what the tariff's for. The
Right.
tariff is for bringing those jobs back. There's no question that the U.S. cannot make that iPhone for less. There's no question. There's just no possible way. So it is going to be more expensive if it's made in the U.S.
So let's talk about the 10-year, because that's been kind of interesting. So when we've had all of these rate cuts by the Fed, because they did cut rates a little bit, like late last year, everything else a quarter point, we weren't seeing that reflected in the mortgage rates. So people didn't understand, it's like mortgage rates are either going up or staying the same, even though the Fed did do a couple rate cuts. Well, that was because the 10-year was too high, right?
Yeah.
So now the 10-year, because there's so much uncertainty in the markets. Like the 10-year is like a safe haven for investors, okay? It's where they put their money. They don't get as much of a return, but it's really safe. Well, before there was a lot of better options than the 10-year. Now with all the turbulence in the market, people are investing in the 10-year, which actually dropped mortgage rates this past week.
Yeah, it went into the high threes. And this is the one that I follow because we use that to lock in our deals in the multifamily. But now I think this morning it was up over 4 again, but it's still, I think it went down to 3.86 or something, and now it's a little bit over 4. And so, yes, the 10-year is an important thing to watch. I'll tell you guys, we just locked a deal 2 weeks ago. We're buying 280 units, and we did a rate buy down too. We're at 5.1% fixed. Full term interest only, IO it's called. Full term. So 10 years IO, 30-year AM, 35-year AM. And now the loan to value was a little bit less, but 5.1, I think it was 5.16 is what we locked. That's pretty darn good. And that was because the 10 years actually coming down a little bit.
Yeah, and so those of you looking to buy a house, I will tell you that buyers were out in droves this weekend in our market because the rates are down a little. As we always tell you on the channel, when rates go down, prices do go up unless there's some kind of big job loss or recession, which might happen, but it might not happen. We're kind of waiting for that, right?
Well, people are solving to a monthly payment.
Yeah.
It's different. All right. We all know you guys are going to solve to how much you can afford each month, and then you're going to back into the price of the house.
Right.
That's normal. That's what you do with cars. That's what you do with houses. And so if rates go down, which they did actually, then that actually helps the single-family home market. Now, it doesn't necessarily mean that they're immediately going to jack the prices, especially if the days on market's also increasing right now.
Correct. Yep.
But it could mean that there's more sales. because but it could also mean that people are stretching for a little bit more of a home.
Yep. And this 10-year, as it's lowering, that does signal that there could be a recession, right? I think J.P. Morgan came out and said now there's a 60% chance of a recession.
Jamie Dimon came out and said that.
Yes, David Dimon, sorry. But the thing is, too, with that is that it doesn't mean it's going to be another great recession. People always think like the economy has to boom or it has to fully bust like an '08. Like it can be just a normal recessionary cycle, too.
Well, I laugh because I think it was either Goldman or it could have been J.P. Morgan. Last week it was 30%.
Right. Well, that was before all the tariffs
Yeah,
came out,
I know, but still, it was just a week ago. So I was like, 30%. That's still less than half. Now it's 60. It's an interesting number. Basically, might as well just say we're not sure. It's 50-50.
Right.
So, but one thing is, I do believe that we're going to see in the short term some inflation. We have to. Everybody's coming out and saying it. And if the Fed has historically been trying to target 2%. Let's don't forget, it's on their website. If you go Google the Federal Reserve, you'll see that their goal has always been 2%. And so they're going to be, that's how historically they've decided where the rates are going to go. They're either going to go up or down. That's in the Fed.
It is, but you're also having the 10-year lower, which puts recessionary fears, which then puts pressure on the Fed to lower rates. They are going to have a lot of pressure to lower rates from, the markets,
but
from the president.
But in this case, we have an actual statement from Chair Powell. So that you just showed. And so I don't know. I think
he contradicted himself though, because he said high inflation and a slowing economy. Like he basically said high inflation, which would indicate rising rates, and a slow economy, which would indicate lowering rates.
Well, we'll have to finish this one over a glass of wine. This is a glass of wine discussion.
But I do think it's interesting that he specifically said that. Like, if you really look, he specifically said that because he is keeping the door open for either way.
Well, Trump is not going to want high rates. I guarantee that. And
yes.
But I will tell you, all things being equal, if we roll into stagflation, which is higher prices, higher unemployment, higher inflation, the history has been that the Fed raises rates, which, of course, I do not want.
But when there's high unemployment, don't they lower rates?
That's not what they did in the 70s.
But it's what they did in 08.
Yes.
So it just kind of depends. But in 08, we did not have inflation.
It's like Eric Freeman. Everything he says, I ask him a question, he says it depends.
Well, but in 08, we didn't have inflation.
True. We did, but not like we just had.
Right. Not on the scale that we're
But
thinking.
in 2022, the most recent, when it was a 9.1, we had inflation, and the Fed reacted and raised rates.
It'd be interesting for those of you listening to let us know if you think the Fed is going to raise or lower rates, because you have a good argument either way. And if you're somebody that's in the market right now looking to buy a house, this might be a sweet spot where rates have went down a little bit, and right now it's a buyer's market. If you wait, prices may go down and it may turn into more of a buyer's market. Or if rates lower, people might get off their seats and start buying. So it's really hard to know.
Listen, we are going to have supply chain disruption, for sure.
Mm-hmm.
Okay, so what that means is what drives prices down? More of something. Okay, so tariffs mean less of something, and so that's all. And so if we start to see these creep, which we very well could. I can't imagine. And unfortunately, I read something that said this is it's called a regressive tax. It actually hurts the poor more than it does the middle class and the wealthy.
Tariffs, you mean?
Yeah.
Mm-hmm.
Yeah, which is horrible, right?
Mm-hmm.
Because not that they need this, right? And so, it's just going to make the basic stuff more expensive.
Yeah, and it is. And us as investors do have upsides to, things going down. Like it could be a good buying opportunity in the stock and crypto market. If real estate prices go down, it could be a good buying opportunity there. But for those people just looking to get by day to day or just buy a house to live in, this creates a lot of uncertainty. But I do want to talk about what low interest rates do to housing costs, because I think that that's important to note for people. Obviously, it gives you a cheaper mortgage. Everybody kind of knows that. But it also can make housing prices go up because there's more buyers that enter the market at different price points.
Yeah, I get it. I love this chart here. Jerry, is this up?
Yeah.
Right? Yeah, so all that's true. It can. But, the thing that's going to push home prices up, if we have higher unemployment and, call it wage price spiral, which could also happen. If prices are going up, higher unemployment and high inflation, it very well could be that less people are in a position to buy a home, right? And it could push more people into the rental side, possibly, right? Mm-hmm. You're right about the lower interest rates, but all things being equal, I mean, the housing markets have done really well with double-digit interest rates in the past, right?
Yeah.
So you have to look at the whole picture, which is what's going on with the individuals.
Well, Charlie's asking, what's your evidence that there will be less products, right? Like, so let's just talk about homes since that's what we specialize in. So there's going to be less homes because if it's so expensive to build that people can't make money, whether that's because tariffs have made prices go up or manufacturing here has made prices go up or the real estate market slows down, then there's no reason for a builder to build if they even feel like they can't make money. So, because, building is a process. You don't make it in a day and sell it in a day. So they have to be confident in the futures of what they're going to be selling and that they can make money. And if they don't feel that way, then they're not going to start delivering product and start the building process until they feel that way.
Well, we already saw that. And if you go back and take a look, it's a good question. There's a couple other factors other than the tariff issue that have already started this, and that is the high cost of interest. We did a show a couple weeks ago. I think we pointed out Lennar Homes, I think it was, that they were spending, was it almost, it was 13% of their home costs. So like a $400,000 home was spending almost $50,000 in upfront marketing costs and mortgage buy down costs. And in addition to that, Lennar Homes also has higher interest costs to build. So if you're going to build a home today, the construction interest is it's expensive. The interest on the construction loan. So it's it used to be in the 3, 4, 5% range. 3 is a bit of a stretch. Let's call it 4 or 5. Now it's in the 8 to 9% range to build that exact same home, and that's just interest cost. So you have that, and then now you're also seeing these big home builders are spending a significant more money in the $30,000-$40,000 per home for rate buy downs just to actually get people into these houses. So people are still solving to that monthly payment, but the home builder is actually eating that cost. Now these tariffs, that was all before tariffs. Mm-hmm. So the tariffs, nobody can argue that there aren't components inside of that home that are going to be imposed by a tariff. Like, for sure, there's thousands of things inside of that house. It'll be interesting to see how all that creeps in. But, and there's a lag here too. So,
yeah, it's going to be very interesting. Before we jump in, I want to ask some questions to those listening. I think it's a really great conversation. But I do want to talk about Limitless. We have Limitless coming up at the end of July. It's a big event that we do.
Limitless Expo. Yeah, you guys, last year we had 1,000 people, or actually 2,000. We have 50 speakers, 3 stages. This is going to be one of the big topics, tariffs. Just emailing with a guy over the weekend. Hopefully the Trump tax policy is coming out in May. I've been told it's going to come out right around Memorial Day. And one of the big panels we're going to have is how to best navigate some of those tax policies, because there's going to be all kinds of things like bonus depreciation, opportunity zones, carried interest, all that, the 1031 exchange, all that stuff. So this is going to be this year specifically, especially with everything going on. I can tell you we're going to be talking about taxes and tariffs and inflation. So this is designed to bring in those experts so that you guys can learn. So look forward to seeing you guys there.
So Josh has an interesting comment on YouTube. They said, all people hear is lower borrowing rates without thinking it could be bad, i.e. let's add tariffs and it'll drive up inflation and push rates down. And I think that that's a really good point, because I think everyone says, oh, another 2008, another great buying opportunity, just like back in 2008. Well, what people don't realize is in 2008, it was very, very, very difficult to get a mortgage because banks were not lending. So you want really low rates, but also really low rates also mean problems in the economy. And unless you have cash, you might not even be able to qualify.
But let's take a look at what was really going on in 2008, because I went through this. There were, 7-8 million homes that went in default. And hit the market. And obviously, we can go down a bunch of rabbit holes here. But the reality is that there was a tremendous amount of supply that hit the market, and there was a shift of people that moved from home ownership to the rental market. By the way, this was the beginning of the rental market boom. So if you take a look at just home ownership, it got as high as 69%. Under the Bush administration, but it all started with Clinton before that, and then everybody needed to own a home, and then they had the Down Payment Act after that, and it kind of pushed home ownership to an all-time high. Then it popped. Then all of that stuff hit the market, and all of those homes hit the market. That's what caused the prices to drop. We do not have that scenario in this right now. Okay, we do not have an oversupply of homes. In fact, if you take a look at the MLS, the multiple listing service, I think we're still below 60% of the historical average. So typically, a home being on the market 4 to 6 months is considered average, depending on the market. So that's typical. So that when it's in that spot, or they call it the sweet spot, that's when there's equal tension between the buyer and the seller. When it goes to 1 month, then of course the seller's got all the advantage. When it goes to longer, let's say 7 or 8 or 9 months, then of course the buyer has all the advantage. And so typically that's 4 to 6. So right now we are not in that scenario. Right now we have rising home prices, and we have a low supply of housing. That's where we are. And so it's very different. So if homes continue to go up, then what could be very interesting is, if they do, by the way, then these tariffs, people are still going to be building because if home prices are going up, it's going to be an opportunity to build more homes.
But if they're not going up, that's when it's going to be the problem.
And the one thing that will equalize all this will be the interest rate.
Yeah.
Because you just have to look. There's been a massive pullback of permits and new construction and starts, which is something that we watch in every market. And that's specifically because of the interest rate costs. When interest rate costs almost double on what it is that you're going to buy, what it is you're going to build, then you pull back.
So Douglas had an interesting question or comment. He said, when rates fall, will the banks be willing to lend to buy housing when banks can get a risk-free low return from the treasury market?
I don't know. That's a great question.
Yeah. Well, banks are more liberal when there's higher rates because they're making a better return, right? And so as you lower the rate and their return gets less, then it's obviously riskier for them to do the loan, right? So, I mean, it is a good question because investors think the same thing. That's why the 10-year, nobody was investing in that and rates were higher because it was a better option to invest in other things. But now that those other things are risky, people are moving to more conservative investments. And banks definitely, as the economy turns, they definitely get pickier on who they're going to lend money to.
And let's jump over into the hard asset category real quick, and let's just have a mention of it. Some of you, I'm sure, are gold and silver bugs. Certainly in our collective mastermind, we've got Daniel Samuelson and Mike Maloney, both are members. And gold is, what is it now, Jerry? Up over 3,000. It's about 3,000. And so people typically with this, there's a flight to a hard asset. Real estate is considered one of those hard assets. It'll be interesting to see what happens now that the stock market got clobbered last week as a result of a lot of this news. Some of it's all baked in, but I would tell you that typically as there's losses in one area, people look for things that are I guess a little less volatile.
Yeah, absolutely.
And crypto, I have no idea.
Ken doesn't know anything about crypto, really. Richard is asking, and those on YouTube listening, feel free to ask some questions. If we get a lot of job loss, does it matter if interest rates drop? So basically for home prices.
Yeah.
So that's the thing, is that
I think it does.
It does, because it affects the buyers. So right now you have a lot of buyers.
Also,
they're just kind of waiting on the sidelines. But if you get layoffs, you have much less buyers.
Yeah, and lower interest rates help everybody, especially the consumer, right? Yeah. So think of debt, any kind of debt, right? Doesn't matter what it is. That if that goes down, the cost goes down. That's good. If interest rates go down, there'll be more housing built. Whatever kind, condos, single family, multifamily. So, and typically when rates go down, there's more consumption. Now, the other side of that is it also can create a bubble, which we've seen. Certainly we saw repeatedly over the years. So that's the other side of it.
Mm-hmm. If you were somebody looking for a home right now, not an investor, someone looking for a home, how would you be thinking about what's happening right now in the market?
I always think you should buy.
Yeah.
I do. Like if you could afford it, if you're renting, let's say,
right,
and you can afford it, I believe you should be in the game. And I tell everybody this, I bought houses really correctly. What I mean by that is I bought them at the right time of the cycle, and they've gone up like crazy. The one we just bought, that's exactly what's happened. I've also bought them where they haven't. So I told a lot of people this. I built a home in 2007, 2008, and moved in around 2009, the exact wrong time. However, because it was the home I raised my kids in, and I wasn't really watching the number. I didn't really know what it was worth from year to year to year, because the intent was I moved into it and I was doing my thing. After the kids moved out, then, of course, I started to take a look. But so it's very different. If you're trying to buy something as an investment, big difference.
Well, if it's an investment, it has to cash flow. But if you're just a buyer and you're looking to buy a house, I mean, like, what are you waiting for? I feel like everyone's always waiting for the next '08 or waiting for the next big opportunity, but you might not even know it. Like, this is a pretty good opportunity too. It's a buyer's market in most markets, and you're able to negotiate with the sellers, and rates kind of just went down. I mean, if you're trying to time something to get there at the very bottom best time, you're never going to know when that is.
I'll tell you an interesting story. I was playing golf this weekend at my club, and I was playing with a guy that actually owned a house on the golf course, and he sold it like 3 years ago, let's say. And he's like, "That was the worst decision I ever made," because now he's renting. And I said, "Why'd you do it?" "Well, he made a lot of money because the house went up." But I said, "So what are you upset about?" He goes, "It wasn't the actual equity. It was the interest rate I walked away from. I was in the high twos."
Mm-hmm.
That's what he was most frustrated about. And so the point is, you're always, once you're in the game, let's say you're in at I don't know, 6% today. If rates go down, you're going to be able to refinance on the way down. If they go up, then you're good at 6. And so in his particular case, he just kept refinancing on the way down until he had a low rate, and then he actually ended up moving out of the city to another spot, and he sold, and he rented while rates went up again.
So basically, everyone thinks rates are so high right now, and they are higher than they've been in a long time, but over the years, these are just average interest rates, right? So, for example, when I was at my bank, I had a home equity line, and it was at 5%. So the home equity line, it went up to 5%. It started at 3%. There's an option in my bank where I can fix that rate and then, turn it into a loan. So I did that, and everybody thought I was so silly because they're like 5% so high, rates are coming down. Well, rates went to almost 7, and here I am sitting at 5, and I walked into the bank and they were like, wow, that was actually ended up being a really smart decision. So as you buy into this economy and you buy a house and your rate is at 6.5 or 6 or whatever it's at, you might look like a genius if rates continue to go up. And to Ken's point, as long as you have equity in the home, you can refinance when rates go down. But it's like, a lot of people, they just wait and wait and wait. And realistically, you have to try to understand what you're waiting for if you can afford the payment and you like the house. Because also all the money that you're putting into rent year over year accounts for something as well.
Yeah, you're paying down your own house,
right?
And there's nothing wrong with that. So when I built the house that I bought at the wrong time, or built at the wrong time, 2008, 2009, I was at 2.8% construction to perm. So it was an actual construction loan because I built the house, designed the house, built the house, and then it rolled into a perm, and I had that loan forever. Right. And it wasn't very much, and it's now paid off. I actually still own the house. But the reality is like my friend, you start to look at these rates that you had, and there's a lot of theory out there about, like Danielle used to believe, this is an interesting point here. She used to like to pay everything off. Remember?
Yeah.
So she had everything paid off, and we took a look at some stuff that she owned recently. She had a loan that was, you're in the 2s on something, right?
Yep.
And the one that actually had debt on it actually gave her, because if you take a look at the equity she had involved plus the return, she actually did better on that than the one that was paid off in full. So you need to look at the imputed equity plus the return if you're doing it for an investment.
Right.
And so if you're doing it, but I always say that if you're just renting, you just got to get into the game. If you can afford it, buy the house you want, and that, I still believe that.
So Vape says homes are selling what they were in 2020. Homes are still selling twice what they were in 2021 near me. So I guess I'm waiting for homes to come back to reality. If they never do, I'll move states, but I'm a cash buyer.
Oh, there you go. Yeah. So, and so some people so I don't really look at my personal home like a stock. Mm-hmm. Like a lot of people look at it like a stock. Mm-hmm. Like, is it up? Is it down? And I'm not saying you shouldn't. I'm just saying that that's not how I see it. I absolutely positively look at my investments that way. So it's a very different mentality. Like the home that we just bought, you can't do that with, right? It's one of these homes that, it took 5 years to build, and so it was one of those homes that you just buy it, and it's an awesome place, and I'm glad we bought it. But and maybe I'm hoping it goes up, but I don't know. I mean, you never know. It's where I want to be. Now, on the investment side of the equation, it's very different. It's all cash flow based. Obviously, I want some kind of value add, and I want to time the market. But if I have a renter in there, if I'm fixed and I have a renter in there paying my mortgage and all my expenses, and I'm cash flowing, do I really care if it goes down 50 grand or up 50 grand or up 100 grand? I don't. And if rates go down, then of course the bank's going to take a look at your loan to value and your debt coverage and all that kind of stuff, and that's just going to make your cash flow better. But you're hedging the up and refinancing the down. I think it's a great strategy. And it bodes really, really well into the lag that I think what these tariffs are going to bring. I personally think that we're going to have to see some higher inflation coming. And the one thing that you're going to want to be in is a hard asset.
Yeah,
So,
whether that's gold or real estate.
It doesn't really matter what it is. And that could be also a fixed rate mortgage.
So Joey had a good question. He's asking, do you think after the tariffs, Trump will make it better by changing taxes to make it favorable for builders and producers in the U.S.?
That's a good question. I do actually think so. I think one of the things that you guys all should be watching is the Trump tax policies. And this is specifically, we're going to have a panel on this at Limitless because, and I'm already putting together the team for that. I got the top 1031 guy in the country. He does $1 billion a month in 1031s, and so we're putting together this team right now. I absolutely positively think that the Trump's a real estate guy, and he's going to be all over this industry. He's going to extend the opportunity zones. I believe that. He's going to bring back bonus depreciation to 100%. I believe that. I don't think we're going to have any issue with the 1031s. And I also think there's going to be a ton of incentives. He's already said he's going to bring some federal land into the fold, more land to build on. Now, I'm reading into this. It's not a slam dunk by any stretch of the means because a lot of the state land is state land, not federal. And there's a lot of complications around it on exactly how it'll be used. But more land and builder incentives and first-time home buyer incentives for sure are needed. And I can't imagine he's not going to come out with that.
So we will see. The Fed meets today. What's your prediction? Rate cut or nothing? Or rate increase?
Flat.
Flat. Me too. So we'll see, and we'll see you guys next week.